Today, we're going to be walking you through why it's the most challenging leasing market in at least the last 5 years. So, thanks to Rent Engine for this report. And it's provided for property managers as a source of data, survey, and information that they've collected through their leasing platform to give us some insights into what's happening in the market. So, I wanted to just simply take you guys through one of their most recent reports. And so, one of the things they did was consolidate some information from a popular newsletter that's in the property management space. So, Peter Lohman has a great newsletter, did a survey of mostly property management company owners that are reporting this data on how did their leasing go during the summer this year compared to last summer. So as you can see, somewhat slower and much slower is the biggest piece of the pie. And that's what we've seen. That's what we've also talked to other property managers in our Tampa Bay market. But then just across the board nationally, everyone is really struggling with time to fill units. And although the lead flow is down a little bit, the conversions are up. So there's sort of better quality residents that are in the marketplace, but just a lot more challenging now than it ever has been before, which aligns with some of the talks that we've had on some other videos about renewals and trying to just keep tenants in place as much as possible. And when it comes to price reductions, they're seeing at least 2 price reductions per listing, which just means that the prices are a little bit high to start with. So we've been, if we have a property that we think is going to rent for $2,500 or 24 to 26 is a range, I'm really pushing owners, or teams are really pushing owners to go with the 24 mark. And just as investors ourselves on properties as well, like just today, we're listing one of our own personal rentals, $100, maybe $200 below sort of the market a little bit, or the competition, I should say, because if you have another competing property, you might have to price lower than you would like just to sort of get the deal done first, get those same renters. So we like to do reductions at least weekly. I think once you have, it's been on the market 7 to 10 days, you have a pretty accurate idea of where it's going to fall. So here it's kind of showing a number of changes based on days on market, and where your most activity, which we'll go to next, is going to happen within the first week, maybe two. I think it also depends on the time of year. So right now, this is end of year, slowest time of the year. You need to be even making adjustments even faster than you might when it's during the summer and it's peak season. So 38% of all leads arrive within the first week on market. But as you can see, you're basically your bulk is within the first 2 weeks where you get the most juice. And most of those showings, from what we've seen, Tuesday to Saturday, it's kind of your most activity. And then we also have systems and tools where we get a lot of people that book times or schedule after 6 o'clock. Lots of people booking times or inquiring about rentals, right? They're probably getting off work, looking at stuff. So having the ability for technology to assist residents to book a scheduled showing anytime they want, or at least inquire and get information back pretty quickly, is pretty important. So lead activity by hour, as you can see, just really is kind of peaks midday and trails down through the evening, but 0.5%, almost 50% of leads are scheduling their showings while the office is closed. So peak times, 10 a.m., busiest day of the week, Thursday, and having the ability to have automated follow-ups. So we do a mixture of automated technology follow-ups with the resident after a showing. We do a mixture of in-person and self-showing, just depends on maybe schedules or what the resident would like, that sort of thing, and to give them flexibility on when they're able to take a look at it. So there's automated communication, but like I said, because it's the most challenging leasing market we've had in a long time, we're having to do a lot more personal follow-up on showings as well, just to get feedback and see what they have going on. So showing lead time and days versus completion rate. So long lead times kill the showing momentum. So when somebody reaches out for a showing, you want to try to get them to see the property within just a few calendar days, or the likelihood that they're going to convert to a showing goes down dramatically. So, and then you often see people that schedule out 5 days, 7 days in advance. A lot of times they'll cancel those showings. They've found something else in the meantime. So really important, ideally within 48 hours, we're getting to showings, but definitely there's some urgency around that. And then, we do, like I said, a mixture of in-person and self-showings, are called, accompanied or just on a lockbox, and kind of depends on schedules and stuff, but very high adoption in the marketplace for that. Residents are familiar with that. A lot of the huge institutional companies have been doing self-showings for a long time, and Invitation Homes, Progress Residential. So it's something that's normalized. There's different ways to make sure that you're keeping up with the property. Even when we do self-showings, we still send people by to do safety checks on the properties, and make sure the keys are there, property hasn't been interrupted, and we collect documents from those people, copy of driver's license, all this sort of stuff to make sure if something were to happen at the property or they forget to put the key back, we're able to either track it down or figure that out. So based on bedrooms, also, studios, one beds, especially when it comes to multifamily properties, you're going to have the most turnover just over time because growing families, right? So 2, 3, 4 bedrooms. When it comes to apartments, two to threes are really good to have if you're an investor looking for a property or you're going to build something. 2 bedrooms at least is always a good sort of bet to go with. And then price range, most competitive being 1250. We don't have too much of that in our market within Tampa. But we see 1,500 to 2,500 sort of your max like competitiveness in the marketplace. And so if you have multifamily properties, you definitely need to be taking a look at some of the nicer, newer buildings around, especially ones with amenities. If you don't have amenities, because they could be pulling your tenant base. They could be pulling your tenant base up into those properties, especially when they're offering 1 month free, 2 month free, plus a reduced deposit. That's where some of the competition we see for smaller multifamily, let's say 5 to 50 units, where you typically don't have a lot of amenities, if at all, could be getting pulled into that. And then, of course, because housing rates I don't think they might go down a little bit more, but what you have is, it's not pulling a ton of renters up into the housing market, but we have had some residents that have bought properties. As that sort of gets more affordable, you might see some more turnover from that as well. One thing that I think also is interesting that they reported on is their credit scores, right? So typically people rent because they may not qualify for a loan. They may be saving down payment. They may be new to the area, haven't decided where they want to live, or they just like the flexibility, which is totally fine. But a lot of times the credit scores is something that are not just going to be super good. I mean, you might ideally want over 600 for a credit score. I would say most of us stuff we see is anywhere from 575 to 675, somewhere in there. So I am sort of kind of surprised that they have some data that supports just seeing lower credit scores. It'd be interesting to see how this changes over time. And then also multiple of rent on household income. So typically you might want at least 3 times the household rent for the income of the group. And average application fees, a lot of times a big piece of that goes to the software automatically as soon as somebody submits an application. But it's interesting, something that we pay attention to is what's the market doing? So in your local market, what are your competitors charging for application fees? You can always look at the big Class A multifamily buildings on what are they charging for pet fees, deposits, monthly pet rent, application fees, and just making sure that you're generally in line. I would say most of what we see is anywhere from $75 to $100 for an application is pretty common in the Tampa Bay area. And there are some other benefits that we've been able to offer to also increase likelihood of renting is a security deposit alternatives. So we have a program where somebody can basically pay a monthly rate into a security deposit versus having all the money up front. So wanted to just walk you guys through a few basic details here. If you'd like a copy of the report, just reach out to us and happy to share this with you. But that way you can go a little bit more in depth. We skipped a couple of slides on how much texting and stuff you might get from potential applicants and that sort of stuff. But overall, the general consensus being much harder to lease, and they do mention average days on market is 27. I actually think that's quite low. That's like very fast. Depends on time of year, depends on geographically where you're at, depends on asset type, price point. We've seen data that I think is more broad than this report that supports 45 to 60 days on market is more of what people are seeing across the board. And so just depends on a few factors there. I think you're always safe to be at least over 30 right now. Again, unless you're pricing really aggressively. So hopefully you guys enjoyed some of this. We'll try to do a couple more updates for you guys, but internally we're adjusting prices at least weekly, if not faster. We're sort of underpricing or being on the lower end of the spectrum when it comes to a rent range, and just a lot more consistent follow-up needed to get the deal done. And if you're in a lower end area, again, as always, though, you just need to go through more leads to get to more applications, a lot less qualified people on the lower end stuff. Obviously, it's more of an affordable price point, and that's where you just struggle to see the credit scores that you'd really like or the income that you really like. Might be able to offset that with a deposit, but that kind of just comes with the territory of buying properties in sort of lower income areas. So hopefully some of this data was helpful for you guys. Stay tuned for more.